Most people think the cost of living crisis means groceries are expensive and rent is annoying. That is too small. The real crisis is that normal life now has hidden toll booths almost everywhere. The apartment, the car, the doctor, the phone, the childcare bill, the bank account, even the checkout screen asking for one more payment. By the end of this video, you will know the warning signs that prices are not just higher, but that the whole budget system has changed. This is based on public economic data, household surveys, housing research, and the everyday money patterns people often miss. The first sign is that inflation cooling down does not mean life became cheaper, and that difference is where a lot of public confusion begins. This is the part many headlines leave out. When the Bureau of Labor Statistics says prices are rising more slowly, that usually means the climb has slowed, not that the mountain disappeared. In March 2026, consumer prices were still higher than a year earlier, and real average hourly earnings were only barely ahead over the year. That matters because a paycheck does not fight last year's grocery bill. It fights the whole stack of price increases that already became normal. If cereal, rent, insurance, and restaurant meals rose for years, a small improvement in inflation is like taking one brick off a backpack after adding 30. The person carrying it may still be crushed. A family does not get a refund because the rate slowed. The rent renewal is still higher. The insurance bill still lands. The grocery total still reflects the last several years, not just the latest month. The controversial truth is that many people are not reacting to one bad month, and they are not being dramatic when they say official good news does not match their kitchen table reality. They are reacting to a new price floor. Once prices reset upward, families need much larger income gains to feel normal again. So when someone says inflation is down, the better question is down from what, and compared with whose paycheck? The second sign is that rent has become a permanent income tax for people who do not own property, and it is often collected before a person has any real chance to make progress. Housing researchers at Harvard's Joint Center for Housing Studies reported that renter cost burdens hit another record high, with roughly half of renters spending more than the usual affordability limit on housing, and more than a quarter spending over half their income. Think about what that means in plain language. Before food, before gas, before medicine, before a phone bill, before saving $1, the apartment has already eaten the budget. People then blame themselves for not saving, but the math is already broken. Rent is also sticky. It can rise quickly when demand is tight, but it rarely falls with the same speed when families need relief. It usually does not fall quickly just because inflation cools. A landlord's mortgage, insurance, property taxes, maintenance, vacancy risk, and local demand all push in different directions. Even new apartments do not automatically save the lowest income renters if the units are priced for higher earners. So the crisis is not just that rent is high. It is that rent now acts like a gatekeeper to everything else. If you overpay for shelter, every other choice becomes a trade-off. Dental visit or car repair, groceries or electric bill, credit card minimum or school clothes. The third sign is that homeownership is no longer the easy escape route people were taught to believe in. For decades, the advice was simple: stop renting and buy. But that advice assumed normal home prices, normal mortgage rates, and manageable insurance. Today, a buyer may face a high purchase price, a higher monthly payment from interest, rising property taxes, and insurance premiums that have become a shock in many markets. Some owners are house-rich and cash-poor. They may have equity on paper, but equity does not pay the electric bill unless they borrow against it or sell, and both choices can create new problems. Some buyers can qualify on paper but cannot breathe after closing. The strange twist is that homeowners can feel trapped too. Selling may mean giving up a low mortgage rate. Moving may mean buying the same size home at a much higher payment. Repair costs also punish owners in quiet ways. A roof, water heater, appliance, or heating system does not care that wages are tight. Neither do contractors, permits, insurance deductibles, or property tax reassessments. It breaks when it breaks. That is why the old rent versus buy debate is less honest than it sounds. It assumes both doors are open. For many households, renting is expensive, buying is unreachable, and staying put is the only option that does not immediately explode the budget. The real divide is between people who locked in cheap housing years ago and people trying to enter the market now. Two families can have the same income and live in the same city, but if one bought before rates and prices jumped and the other is starting today, their lives can feel like different economies. The crisis is not only a lack of homes, it is a timing penalty on younger households and anyone forced to move. Divorce, job relocation, a new baby, caring for an aging parent, or leaving an unsafe neighborhood can all trigger a much higher housing cost. The market punishes life changes. That turns housing into a trap, not just a bill, because the cheapest choice may be the choice that keeps someone stuck. The fourth sign is that food prices are still hurting even when a few items go down, because the grocery store is where people meet inflation face-to-face several times a week. Grocery inflation can look mild in a monthly report while families still feel squeezed because the total basket is not one item. Eggs may fall 1 month, but fruit, drinks, snacks, meat alternatives, lunchbox food, and prepared items may still be higher than people remember. The Bureau of Labor Statistics showed food at home still higher over the year in March 2026, and food away from home rising faster than many grocery categories. That second part is important. A lot of working people do not eat out because they are careless. They eat out because schedules are brutal, commutes are long, and cooking takes time, storage, energy, and planning. A cheap fast meal becomes a time management tool. Then the price rises, the tip screen appears, delivery fees stack up, and suddenly convenience becomes a luxury tax on exhaustion. The family is not just buying food. They are buying back time they no longer have. The hidden detail is that people remember prices by anchor points. If a family remembers what a weekly shop used to cost before the pandemic surge, even a small new increase feels insulting. They are not confused. They are comparing today to the last time their budget made sense. That memory is powerful. If a cart that once felt routine now feels like a financial event, the person does not need an economist to explain the pressure. They can feel it in the checkout line. And the checkout line has become a weekly referendum on whether the household is improving or just surviving. The fifth sign is that food insecurity is not acting like a problem from a poor country or a distant recession. It is inside ordinary communities. The Department of Agriculture reported that in 2024, about 13.7% of U.S. households were food insecure at least sometime during the year, and households with children faced an even higher rate. That does not always mean visible hunger. Sometimes it means adults skipping meals so children can eat. Sometimes it means buying filling food instead of healthy food. Sometimes it means stretching one dinner into tomorrow's lunch. The public often misunderstands this because the refrigerator may not be empty. Hunger in a wealthy country often hides behind substitution, stretching, and quiet embarrassment. It may be full of the cheapest calories available. The quiet scandal is that people can be employed and still food insecure. Work no longer guarantees enough margin to absorb rent, car costs, and food at the same time. Food banks have become a pressure valve for wages that do not match living costs. Churches, school pantries, community fridges, relatives, and neighbors quietly fill gaps that the labor market leaves open. So when someone says people should just budget better, ask what kind of budgeting turns a too small income into a bigger one. Budgeting can reduce waste. It cannot repeal arithmetic. The uncomfortable lesson is that hunger can exist in a country with full shelves because access is not the same as abundance. Food in the store does not mean food in the home. The harsh part is that shame keeps many households quiet, so the crisis looks smaller than it is. The sixth sign is that the car has turned from a tool of freedom into a second housing payment, especially in places built around highways instead of reliable transit. A car is not just a purchase. It is insurance, repairs, tires, registration, fuel, interest, parking, and the risk of one accident destroying the budget. New vehicle prices stayed high after the supply shocks, used vehicle prices stopped feeling cheap in many markets, and financing costs made the monthly payment heavier. The Bureau of Labor Statistics has tracked pressure in transportation services, vehicle repair, and insurance categories, and many households feel it directly when renewal notices arrive. The painful part is that millions of Americans cannot simply choose not to drive. Jobs, schools, childcare, doctors, and grocery stores are often spread out. Public transit may be limited, unsafe, slow, or non-existent. In many suburbs and rural areas, not having a car can mean not having realistic access to work at all. That makes every car bill feel non-negotiable, even when the household knows the payment is too high. That makes car costs less like a lifestyle choice and more like a private tax for living in a car-dependent economy. It is a tax paid to lenders, insurers, repair shops, fuel stations, and parking systems instead of to one public office. The controversy is this. Some people call car ownership a personal decision, but local design often makes it mandatory. If the car fails, the job may fail. If the job fails, the rent fails. One repair can start a chain reaction. A bad alternator can become missed work. Missed work can become lost hours. Lost hours can become late rent. Late rent can become fees. The crisis spreads because every system is connected. The seventh sign is that debt is being used less for dreams and more for survival. And that is one of the clearest signals that household budgets are under more stress than the surface shows. The Federal Reserve Bank of New York reported that total household debt reached a record level by the end of 2025, with credit card balances around $1.28 trillion and auto loan balances also very large. Debt by itself is not evil. That point matters because the goal is not to shame borrowing or pretend every loan is a mistake. A mortgage can build wealth. A student loan can raise earnings. A credit card can smooth timing. But when people borrow for groceries, gas, prescriptions, utilities, or rent gaps, debt becomes a warning light. The minimum payment can make a household look stable for a while, like tape over a cracked pipe. The account is not late, the lights are on, and the family may look fine from outside. But the interest meter keeps running. Then, interest keeps working when the person sleeps. Delinquencies do not have to explode across the whole economy to hurt. Stress can be concentrated among younger borrowers, lower income areas, and households without assets. That is why average numbers can mislead. If higher income households keep spending while lower income households fall behind, the economy can look okay from a distance while millions are quietly drowning. The sign to watch is not just how much debt exists, it is what the debt is being used to cover. Debt for a durable asset is one thing. Debt for last week's groceries is another. When survival moves on to revolving credit, future income is already spoken for before it arrives. This is how a paycheck can disappear on payday. The money is not spent in one wild moment. It is already assigned to yesterday's survival. The eighth sign is that buy now, pay later has moved from occasional shopping trick to budget bridge, and that shift should make people pay attention. Regulators have described pay-in-4 loans as a fast-growing credit product, and the Consumer Financial Protection Bureau found that a meaningful share of consumers with credit records use these products in recent years. The dangerous part is not one installment plan. It is the way small payments hide the full total. A person sees 4 easy chunks instead of one painful price. That can be helpful for a planned purchase, but risky when used for groceries, clothes, school supplies, or basic household goods. The payment feels light today and heavier later, especially when several plans overlap. This is why the crisis is worse than it looks. Traditional credit reports may not always show the full picture. At the moment, a household is stacking obligations. A person can look current and still be overcommitted. The product is marketed as control, but it can train the brain to ask only, "Can I afford the first payment?" instead of, "Should this purchase exist at this price?" A household can end up managing a calendar of tiny debts instead of one clear budget. The trap is not stupidity. It is frictionless borrowing placed at the exact moment of temptation. The checkout page becomes a lender, the shopping cart becomes a payment plan, and the pain of the price gets postponed just long enough to make yes feel easy. The industry did not invent desire, but it removed enough friction to make restraint harder at the exact second restraint matters most. The ninth sign is that healthcare costs can break families even when they have insurance, which is why the phrase insured does not always mean protected. Data showed that employer-sponsored family health coverage reached an average annual premium of nearly $27,000 in 2025, with workers contributing thousands toward that cost. That is before deductibles, copays, coinsurance, prescriptions, dental work, vision care, and out-of-network surprises. A premium is only the ticket to enter the system. It is not the final bill. Many families learn this only after they need care, when the language of networks, deductibles, formularies, and prior authorization becomes part of household finance. Insurance is supposed to reduce fear, but many people now treat medical care like a financial decision first and a health decision second. They delay appointments. They split pills only when medically unsafe advice is not involved, search for coupons, avoid dental visits, or wait until pain becomes impossible. Surveys also show that many adults carry some form of healthcare debt, including debt placed on credit cards or owed to lenders, friends, or family. That is a powerful sign because medical debt is often not caused by luxury behavior. It can come from an accident, a diagnosis, a child's illness, or one emergency visit. The cost of living crisis is not just the price of living comfortably. It is the fear that one ordinary human problem can become a financial event. The body becomes another bill collector. A toothache, a scan, a refill, or a specialist visit can force a family to choose between prevention now and debt later. The cruel part is that delaying care can make the eventual care more expensive, so the attempt to save money can become the reason the bill grows. It is the price of staying alive and functional. The 10th sign is that childcare has become a career tax on parents, and it lands exactly when many families are trying to build stability. Care reports and childcare researchers have shown that families often spend a large share of income on care, and in some cases the bill can rival rent or a mortgage. This creates a brutal choice. One parent may work mostly to pay for childcare, but leaving the workforce can damage future income, retirement savings, promotions, and independence. The public debate often treats childcare as a private family issue, but businesses rely on parents showing up to work. Every office, hospital, warehouse, restaurant, school, and store depends on someone watching children somewhere. The economy needs children to become future workers and taxpayers. Yet the cost is placed heavily on individual households during the years when they are often least financially stable. The reason childcare stays expensive is not mysterious. It is labor-intensive. You cannot safely watch a large number of infants with one adult. Safety requires people, and people require wages, yet parents are already stretched. Providers need rent, insurance, food, cleaning, training, and staff. Workers in the field are often underpaid, while parents still pay too much. That contradiction shows a broken market. A healthy system should not require parents to pay nearly everything they can spare while caregivers still struggle to afford their own rent. It also explains why grandparents, neighbors, and older siblings often become the hidden infrastructure of the economy. When both sides feel poor, the system is not efficient. It is strained. Parents pay too much, workers earn too little, providers run on thin margins, and the economy still expects everyone to show up on time. It is strained. The 11th sign is that emergency savings are too thin for the size of modern bills, and that weakness is easy to ignore until something breaks. The Federal Reserve's household survey found that only about 63% of adults said they would cover a $400 emergency using cash or its equivalent. That means a large share would need to borrow, sell something, or be unable to pay. And $400 is not a big emergency anymore. In many households, it is not even a full emergency. It is the opening chapter. It may be one tire, one urgent care visit, one utility catch-up, one school expense, one broken phone, or one trip to help family. The old advice says everyone should have 3 to 6 months of expenses saved. Good advice, but for many people it now sounds like telling someone underwater to build a boat. When rent takes half the income and insurance jumps, saving becomes a leftover activity, and there may be no leftover. The hidden problem is that financial fragility changes behavior. People avoid risks that could improve life because one mistake is too costly. They stay in bad jobs, delay moves, tolerate unsafe housing, or keep driving unreliable cars. The cost of living crisis is also a risk-taking crisis. People with savings can take smart chances. They can move for a better job, reject a predatory deal, leave a bad landlord, wait for a better used car, or fix a small medical problem early. People without savings are often forced to choose the safest bad option, because one wrong move could push them over the edge. This is why financial advice that ignores fear often fails. People are not always choosing badly. They are choosing under threat. The 12th sign is that fees have learned how to hide in plain sight, and they often appear after the customer has already invested time, attention, or trust. The price you see is often not the price you pay. That is the entire point of the model. Banking fees, late fees, convenience fees, service fees, processing fees, delivery fees, resort fees, activation fees, cancellation fees, and small monthly add-ons all attack the budget in tiny bites. Consumer regulators have repeatedly focused on so-called junk fees because these charges can make comparison shopping harder. A business can advertise a lower base price and recover money later through mandatory or hard-to-avoid extras. The psychology is simple. People resist a high upfront price, but they often accept a smaller fee after they are already committed. The same trick appears in subscriptions. A low monthly charge feels harmless until 5 or 6 services renew at once. A free trial becomes a paid plan because cancellation takes effort or memory. This is controversial because companies will say customers choose these services. Sometimes they do. But a choice made through confusion, pressure, or deliberately scattered pricing is not the same as a clear bargain. The budget dies by small cuts. This is why people can cancel one subscription, cook more meals, skip coffee, and still wonder where the money went. They are not always fighting one giant monster. They are fighting a swarm. Each charge looks too small to protest, but together they can change whether a household saves, pays down debt, or falls behind. The fee economy is powerful because it rarely feels like a major decision until the month is over. The 13th sign is that shrinkflation and premiumization make inflation harder to see, because the price tag is only one part of the deal. A package can stay near the same shelf price while the size gets smaller. Consumers notice the cash register first, but companies can change the quantity, quality, warranty, service, speed, or access. A basic item can be replaced by a premium version with nicer packaging, new flavor words, or a health claim that justifies a higher price. A restaurant can keep the main price stable but charge more for sauces, sides, delivery, customization, or a larger size that used to feel normal. This is not always deception. Ingredient costs, wages, rent, and transport can really rise. But from the household side, the effect is the same. The old normal quietly disappears. The trick is that people track dollars more easily than ounces, grams, portions, or service levels. They may not notice that the cereal box got thinner, the paper towels have fewer sheets, the frozen meal is lighter, or the basic plan now has limits. The economy becomes a maze of unit prices. The person who checks price per ounce, reads the plan terms, compares package sizes, and notices fewer services is doing unpaid detective work. Families who do not study labels like accountants pay more without seeing a single dramatic price jump. That is why the crisis feels slippery. It is not only higher prices, it is lower value. And lower value is harder to argue about because the receipt may look almost the same while the household quietly receives less. The loss hides in the space between memory and measurement. The 14th sign is that the labor market can look strong while workers still feel weak, because a job is not a shield if the bills grow faster than the cushion. Employment numbers can be good, and yet people can feel exhausted because having a job is not the same as having breathing room. A worker may pick up overtime, a second job, gig work, weekend shifts, or side income just to remain in the same place. The Federal Reserve survey has noted that prices remained a top financial concern, even while many adults said they were doing okay or living comfortably. That phrase, doing okay, deserves attention. It can mean paying bills but not saving. It can mean current but anxious. It can mean one missed paycheck away from trouble. The job market also does not treat everyone equally. A professional with assets and remote work has a different inflation experience from a renter paid hourly who must drive to work. The controversial point is that politicians and commentators love averages because averages are calm. Households live in specifics. Specific rent. Specific commute. Specific medical plan. Specific child care bill. Specific insurance renewal. Specific landlord. Specific grocery store. Averages do not buy dinner. Median numbers help researchers, but families live in cash flow. The day the bill is due matters more than the annual graph. A raise that arrives after rent, insurance, and debt have already climbed may feel like a rescue that came late. The 15th sign is that the crisis is becoming visible through people doubling up, delaying adulthood, and losing housing altogether, even while everyday life in richer neighborhoods can look completely normal. Homelessness counts have reached record or near-record levels in recent federal and housing reports, and even where numbers stabilize, the level remains alarming. But the official count is only the most visible edge. Many people are hidden in spare rooms, couches, motels, cars, overcrowded apartments, or relationships they cannot afford to leave. Young adults delay moving out. Couples delay separation because two rents are impossible. Seniors take in relatives. Families move farther from jobs to find cheaper housing, then pay through longer commutes and higher car costs. This is the part of the cost of living crisis that does not fit neatly into a price chart. It changes family structure. It changes dating, marriage, divorce, birth rates, retirement, migration, and who can take care of aging parents. It changes mental health. It changes who can take a job, have a child, leave a bad situation, or retire with dignity. When shelter becomes unstable, everything else becomes unstable. A society can still have full restaurants and busy airports while a growing number of people are one rent increase away from collapse. That is what makes the crisis easy to deny. Prosperity is visible. Fragility is often private. People dress for work, smile at school pickup, post normal pictures, and still calculate whether one more bill will tip the whole month. If this video made you rethink what normal costs now hide, like the video, comment with the one bill that shocked you the most this year, and share this with someone who keeps hearing that the economy is fine, but cannot figure out why their wallet says something else.